I started this week writing about U.S. petroleum product demand per capita. What we'd seen is demand climbing steadily, getting to the financial crisis. And then once the financial crisis hits, we see a pretty important step downward. Then we see demand bounce around in a reasonably tight range since 2008, 2009. What's interesting is so far in 2023, we are now beginning to test the low end of this demand range. And it has a lot of implications for supply-demand balancing going forward on the petroleum product side. It means that our aggregate demand is even more sensitive to what's happening with population. So it was sort of an interesting look at those dynamics as we started the week. My next post was about Chevron's announcement of its intent to buy PDC Energy for $6.3 billion. And specifically, I wrote about the word choice that Chevron's management team used in their announcement. They used the phrase lower carbon 5 different times through their announcement. So what I said was clearly Chevron's management knows that investors are very sensitive about carbon intensity, particularly on the upstream side where you're actually extracting these hydrocarbons from the earth. And Chevron's management is doing what you would expect to do, which is talking about the importance of them managing and reducing carbon intensity going forward. My next two posts were about West Virginia, and specifically West Virginia's use of coal. I'd listened to the most recent episode of the Energy Transition podcast, and the guest there was a regulator and an attorney who has a lot of experience, specifically in West Virginia, but in different states across the U.S., and talked about the dynamics in West Virginia that had led to that state's increasing reliance, frankly, on coal, at least relative to the rest of the U.S. So I wrote my first post about just how much West Virginia relies on coal and how much more they rely on it than every other state plus DC. The second post in that series was about electricity prices, residential electricity prices, and that over the past 10 to 30 year window, West Virginia is the 7th highest state when it comes to residential electricity cost increases. So this continued reliance, excess reliance on coal for electricity generation is leading to more aggressive price ramp ups in West Virginia than we're seeing in other states. The next post that I wrote about was the IEA this week published a new forecast, and they said they expect in 2023 global investment around solar energy to exceed global investment around oil production, which would be the first time that happened. So it's a pretty interesting data point. That report, if you're looking for something to read, the IEA's new forecast report is a pretty interesting one to comb through. So again, the point there was capital markets are speaking in terms of how we're deploying against the energy landscape in totality. My last post was about the U.S. drilling rig count, and we had another reduction this week of 9 rigs, and that means that we have dropped 44 rigs in the last 4 weeks. And I showed a year-over-year comparison where we're down 16 rigs year-over-year. And it's an interesting dynamic where these rigs are mostly pulling out of gas basins and being deployed into the Permian. But then again, net, we're still down. The retreat from gas basins isn't surprising because last year at this time, gas prices were around $9 per million BTU, whereas right now they're a little over $2. So the economics have certainly justified withdrawals of activity from these gas basins. And again, even as the aggregate rig count drops, we are seeing more consolidation into the Permian, which is a pretty interesting dynamic across the U.S. oil and gas landscape. As always, I put together a weekly newsletter where I include links to and summaries of all the research that I publish during the week. I also include an energy-related anecdote insider observation so that if you've seen all the stuff that I've shared on LinkedIn, there will still be something new for you in the newsletter. The newsletter that I sent today, I wrote about Wright's Law. It's an idea that has shown up in a handful of podcasts that I've been listening to and things I've been reading. And it's about the importance of deploying new technologies because that is one critical mechanism for realizing cost reduction. So I wrote all about that at the end of this week's newsletter. If you're interested in making sure that you see all the research notes that I post, or if you're interested in seeing the anecdote that I put at the back of the newsletter, which I don't share elsewhere, certainly sign up. It's a free newsletter. Like I said, it just comes once a week. It takes 4 minutes or less to read. So I purposely try to make it a pretty light lift for you, but to give you some interesting stuff to peruse at the end of the week. So I will put a link to that newsletter in the comments below. As always, I appreciate you reading and watching, and we will talk soon.